So you have your balance sheet, you have your income statement, and you have your cash flow. Moment in time, valuable documents. But what's more valuable is the analysis that you make with this moment in time. What does the information tell us? How can we use it? First one that we need to consider is current ratio. These are our assets divided by our liabilities. It's a picture of performance. What are our assets doing? Trucks, cash, warehousing, so on and so on, against liabilities, payments that we must make to our creditors of the various types, banks, suppliers, so on and so on. That value tells us how we're performing. Next, the asset test, ready cash. Cash plus accounts receivable and marketable securities divided by our liabilities. Do we have ready cash to pay when the call comes in that says 20 days due to payment at the end of the month? From there, we have our debt equity, which is our liabilities divided by our equity. The calculation there, what's the balance in our company? Are we relying heavily on debt or are we relying on equity to run our operation? From there, vastly important, earnings per share, net income after taxes are paid, divided by the number of shares. This is relevant to a corporation. What is the value of each share? Is it something that an outsider would consider purchasing? From there, return on sales, net income, again, after taxes, divided by our net revenue, net sales. How much do we actually make? If we sell $10 and only have 10 cents profits, what does that mean? And then last but not least, of high value, return on equity. Our net income, again, after sales, divided by equity. That number tells us maybe we should invest somewhere else, or maybe this is the right investment. Performance analysis is what's key from those magical documents. Balance sheet, income statement, cash flow.